Welcome, everyone. Today is Wednesday, April 30th, and we have with us Andrew from Scholes, our very own in-house TradFi boomer, Tolga, and the one and only Diplomat, DK. Welcome, everyone.
Hello.
Good to have you back,
Happy
Andrew.
hump day.
You as well, DK. I feel like Tolga's on the streams more than you now, so
it's kind of happened that way over the last few weeks or month or
He's
so.
prettier than I am. He's more knowledgeable than I am. He's better suited for this kind of work, you know.
So I bid a warm welcome to you as well.
I just
Andrew,
talk a lot. That's the problem. And then you guys are like, "Oh, why don't you get on the spaces? Because you'll end up filling the hour with no issue."
Exactly
being the case. Yeah.
You found us out. Andrew, give us a brief intro. You've joined us before, so some of our viewers have met you, but give us a brief intro on yourself and Scholes, what you all do.
Yeah, absolutely. I'm Andrew, head of research at Scholes. Scholes does institutional grade, high touch, premium quality research, data, and analytics for cryptocurrency derivatives in a line. So for our data product, that means that we're supplying implied vols to whoever needs them, as well as a bunch of other feeds, I think. And then on the research side, where I'm sitting, trying to build out a team that's very similar to what you'd expect from a strategy desk at a bank. So doing a lot of the deep dive research into this asset class, treating it like an emerging technology, understanding the fundamentals, blockchain tech, DeFi tech, that kind of thing, as well as just putting that together to, for our bespoke hedge fund clients, actual tradable insights. We look at volatility surfaces. We're first user of the data in Scholes, putting together vol surfaces, looking for dislocations, backtesting strategies. Yeah, looking for ways to take that data and turn it into something you can trade.
Awesome.
I was muted. Sorry. I was saying awesome. Now, DK, you want to give us people do know who you are, but just for the stream today, let's do a little roundtable. DK and Tolga, you want to give us a small intro on who you are, what you do at Premia Kyan?
Yeah, I'll go first. DK, I've been around in Premia since the beginning. I did 10 years previously at a broker dealer before moving into full-time crypto. At this point, we've been in full-time crypto since 21. So we're getting old in the full-time crypto space. Originally, my previous life was in business intelligence, and so that's like big data analytics. And then in my current role, we wear many hats over the last 4 years, but ran the reg and operations legal side of the house for a bit. I dive into development every once in a while just to make sure that I'm not incredibly dull. My edge is not incredibly dull. But I kind of oversee all the group, the entire group, and kind of lead the strategy. And as the most recent, I've been just banging the drum to getting out our newest product. That's
awesome.
me.
DK,
nice.
the Diplomat. Tolga, on to you, our TradFi boomer, our beloved TradFi boomer.
Yeah. So I guess we'll start with where I got the name from. So I spent about 15 years in traditional finance across the trading space, options as a market maker, did stat arb, did a lot of systematic strategies. So then I kind of jumped over to the crypto side, and I sort of specialize more. Sorry, guys, I'm a little sick today. Specialize a little bit more in the product design side for us. So how the exchange is supposed to operate. How everything mechanically works, from the risk models to order filling processes, the liquidation engine, things of that nature, all of sort of the mechanical design. I sort of help kind of spearhead and work through at Premia.
Sick. Thank you. All right. So now let's get more into how Premia and Block Scholes are working together. The topic of kind of the meta topic, I should say, is oracles and options pricing. So I think it's without too much introduction into the topic, we'll be talking about how we're using Block Scholes oracles for option pricing. But Tolga, if you want to dive into this a bit and talk a little bit more about how we'll actually be using their product.
Yeah, sure. So I'm sure everyone's probably familiar with, exchanges using oracles, right? Oracles are a way to sort of mark the fair value of an asset at any point in time. It gives you a neutral party to sort of verify the price of something versus an exchange, an AMM, or whatever exchange that you're working through. It gives sort of an assurance that the value isn't made up or manipulated, right? And so Block Scholes plays an integral part for us because we have to decide on what the fair value of an option is on our exchange. So because we run a margin system by offering portfolio margin, any kind of partial collateralized systems, it's extremely important that you understand the mark-to-market price of an asset at all times. And so in order to get that, you need to know the fair value of all the options that a user holds. And so in order to do that with options, just to kind of give a quick background for most people, options require two main inputs, and there's a secondary one, but the two primary ones are they need a index price, or like a spot price, and they need an implied volatility input. And so these are your sort of two primary inputs that we use to determine the fair value of the options that you trade in our system. There's obviously interest rates as well, but that's a little bit lesser of an impact-based input. So the primary two are the implied volatility and the index price. And so for us, Block Scholes provides the implied volatility portion to us, in which we can then use that value to determine, in conjunction with an index price that we get from Chainlink, to determine the fair value of the options on our platform. And so why is this important? Well, we run an order book system. And so, and I'm sure people have known that whenever there's, market events or, fat finger trading that goes on, markets can wick, they can do all sorts of weird, funny things. And the last thing you want to do is liquidate users because of some, rogue trade that went through, and someone just blasted a market order, and the market moved 30-40% on that one order, and then caused a cascade of liquidations. So to prevent that, we can use these fair values that we get from Block Scholes and the index price from Chainlink, and we can establish that fair value at all times. So even if there is a temporary dislocation in price on our exchange, we don't go unfairly liquidating a user's account because of that. And so that plays a major role in terms of our system. As I mentioned, again, being a partially collateralized system, you have to understand the mark-to-market price of assets at all times. And so it plays a real critical role in our system. Essentially, without that feed from Block Scholes and Chainlink, our system cannot work, right? Simply, there's just nothing we can do to ensure the integrity of our system without that fair value price. So it's at the heart of our system for sure. I think that explained it all, right? Did that cover everything? Yeah. All right.
I think that was a good overview. Yeah.
You really position this as like the gold dust. I think the implied vols are definitely the gold dust for an options exchange, right?
Yeah.
It's the grail. Yeah, I agree.
Yeah.
Andrew, do you want to talk a little bit about like sort of these, like the Oracle we're referring to, what we're pulling from you guys, how you guys establish those prices, how you guys ensure the stability of that, just sort of like that higher level part that people might not be familiar with Block Scholes?
Yeah, absolutely. So as you mentioned, this thing needs to be robust, right? It's in charge of margin calls for users on the exchange. That's the case with I think a lot of people that pull our data, right? So we need to make sure that we're actually presenting a fair, balanced mid price for the implied vol at a certain tenor or a certain strike, right? So the way we do this is via a composite across multiple different exchanges. We pull from decentralized and centralized exchanges. We pull together options prices. We calculate implied vols at all of those options prices. We use mid. We calibrate a volatility surface to that mid for each exchange, and then we combine them in some sensible way according to some metrics, how confident we are in the data, what their uptime is, how far they are of each other as well. And we try to get a coherent picture of where the mid price is across the volatility surface for a certain exchange. That is market wide, rather than just calibrating to a single one, right? Why would you not do that to the exchange that you're providing that data for, the exchange that's using it? Well, as you said, it's actually very low cost in a centralized order book at least, but on chain, I think the cost is even lower than it used to be. Order spoofing is very common, especially on centralized exchanges. Like I said, incredibly cheap to do so. So it's very easy to move that mid around without actually fronting any cash, and as a result, you can cause liquidation, right? So what we're trying to do is be that sort of robust picture of where the market is. We don't set prices, we don't trade, we don't actually cause trades to happen. We are, that fair mid price for the mark to market of an asset. Of course, once you have an implied vol, then you get your options price, right? And then from your options price, you have a good picture of what your portfolio is marked at.
It's a great point about the spoofing, because with our system, it does not cost collateral to post orders. It only costs collateral to trade. And so it's very easy for someone to come in. Obviously, the price might be unfavorable and they do it just for a short time with no intention of doing the trade, but then they can essentially sit there and manipulate that market and induce, like you said, induce liquidations.
But that's what you want, right? You don't want to charge people for leaving orders. Otherwise, you'll never have market makers on your exchange. You'll never have like the liquidity.
With options, it's the biggest issue, right? Like they have to quote, some couple hundred instruments, right, at the same time, two-sided, right? And asking them to put collateral up for all of that. And to be honest, when you're running a portfolio margin system, knowing what the collateral amount is for any one of those trades is impossible, because
it depends.
It just depends, right? Yeah. So like you could, every single amount that's required changes based on once a single order trades, it affects all the margin requirements then for all the other orders you have out there. And so that complexity and would create a lot of latency and a lot of problems in terms of trying to make a snappy exchange. So we ended up sort of moving away from that, bottleneck that most people have experienced before in like sort of the earlier days of options in DeFi, and sort of went more towards the order book route for sure.
Yeah, I think it is a common solution to that problem, to be honest. I think for something like options, it doesn't fit let's say, a Uniswap model as naturally as Uniswap model has done for the AMM model. Other exchanges are available. It doesn't match that sort of use case for options because you have that fractured liquidity, because it's necessarily a completely non-linear instrument, right? I think a lot of people are moving towards that user experience that comes with a centralized order book, with portfolio margining. Yeah, it becomes more and more necessary the more complex the instruments are, I think.
Now, a lot of that, I think, it has to do with, well, I wouldn't say it has to do with, but Deribit becomes essentially the de facto, they've been the de facto exchange, right, for options for a very long time across CEX and DEX, right? And I think there is a little bit of convergence that's starting to happen. I imagine their market share may or may not bleed out a little bit just due to everyone essentially catching up to them in terms of product features and mechanics. Can you touch on maybe a little bit about how, like, what exchanges Scholes looks at? Obviously, Deribit being the main one. How do you guys deal with scenarios where Deribit goes down? I know that happens quite often. They tend to have maintenance windows. I would say, I don't know, maybe once a month, right? And so how do you guys sort of ensure that you guys always have uptime and that you're always making sure like the prices across maybe multiple exchanges, if that's the case.
Yeah, so what we're delivering to you guys is a composite that is made up of essentially a combination of the volatility surfaces from a couple different exchanges. I think the centralized exchanges we're pulling from are Deribit, Bybit, and OKX at the moment, I think, and we're always looking to integrate more. So the question is essentially, how do we combine those volatility surfaces, right? So we begin with the obvious, calibrating a volatility surface for each one of them, and then you can think of it as like a weighted average between the three, or however many we're pulling in. That is done so that a blip in the data for Deribit or Bybit or OKX or whoever it is does not drastically move the market as we're seeing it, right? So we do that dynamically. Those weights are not constant. And they're based on a couple different things. One is trade volumes on the exchange. You touched on it. Deribit, I think, it ranges, but it's somewhere between 60 and 80%, and historically even higher of options trade volumes.
Yeah.
But I think looking at the data, we are not ranking Deribit as highly as 80% in the composite, because we're considering other factors as well. Those other factors are essentially just a picture of how good that data is. So one, data quality, how much we actually have to filter out using our cleaning systems. We pull that data, we do some checks, arbitrage checks, that kind of thing, make sure the data is reasonable given what we've seen historically, as well as the actual quantity of data that we have. We collect tick data from exchanges, so the more data we have, the more confident we can be in it, the more highly we will rank that data in our composite. So yes, Deribit is something like 80%, but it's not necessarily always going to be that dominant, such that when it's when it drops, we're not missing like 80% of the confidence in where the mid market is for an option price. Now, that will not always be the case. There's always going to be new markets added. I think what's interesting is to see, ETF options. Firstly, how do we think about them? How do we aggregate them across to something like Deribit? Is there an embedded credit risk that we need to consider for something like Deribit, or even on I think they're going to trade NASDAQ, the IBIT options. Yeah, lots of things to consider. This thing will be quite dynamic, but it's already quite dynamic for exactly these robustness reasons.
Talking on these kind of alt options, altcoins, and just things other than BTC and ETH, what inputs do you all use to create those altcoin surfaces?
A deceptively simple question, I think. The main issue is that a lot of what I've described so far for calibration of a volatility surface, it really depends on there being an active market, right? There needs to be option prices trading before we can pull them, calibrate a vol surface, and then spit out options prices back to whoever needs them. Now, that's obviously true for Bitcoin and Ethereum and a growing host of these things, right? Deribit now offers XRP, I think Doge, BNB, Solana off and on for Bybit as well. This is great because we can pull these option prices and we can be confident in them. For a altcoin, something that's never seen an options market or has never traded anywhere, that you can actually pull prices from. It might trade OTC. This question is a lot tougher. So what we're aiming to do there is do you can think of it as like a best rule of thumb for where these where that fair market price would be for the implied volatility. So you asked about the inputs. Specifically, we are taking we're making an assumption that an altcoin, its spots, its forward, and its vol is going to be somewhere near to another coin that does trade. So take Ethereum as an example. For a lot of the layer twos that live on Ethereum, it's quite reasonable to say that a lot of the embedded risk in an altcoin is at least partly reflected by the embedded risk that it lives on Ethereum, and it trades with a high correlation as a result. What we're looking to do is take Ethereum's volatility surface and map that in a sensible way or a defensible way onto an altcoin. And we do that using correlations for, a bunch of arguments that we could get into a bit more detail on if it's relevant, because we want to make sure that, well, let me backtrack a little bit. I think a lot of these assumptions are defensible from a hedging perspective. We are replicating in many ways the methodology that a market maker would do when being forced to quote two sides on a out of the money Arbitrum option, for example, or a high delta or a low delta call option on, I don't know, base or optimism or whatever. The reason that they assume this correlation is because they will look to hedge the exposure they're taking on from an altcoin option using instruments that should have some high correlation. So think of the layer 2s and Ethereum. If I'm, quoting an option on Arbitrum and for some reason I can't trade the underlying spot, then I can use the correlation of Arbitrum to Ethereum in order to trade the ETH underlying to sort of synthetically hedge what I'm doing here.
Yeah.
The same applies to things like options. We're just talking about a slightly different Greek. So in terms of options, what you really care about is hedging the vega. If I'm quoting an option on Arbitrum, say it's at the money and it's a straddle, then I can assume that there is some sort of correlation between Arbitrum and Ethereum in terms of its spot moves, and therefore its volatility should spike at the same time. And empirically, this is what we find, and it is empirically how we set the ratios between how we map from Ethereum's volatility surface to Arbitrum's volatility surface. It's guided by empirical data and this assumption. Trade off the back of it, it's going to be actual market prices that are going to become more and more valuable over time. But to some certain extent, you need to bootstrap that liquidity. You can't have an options market without some reasonable volatility surface. You can't quote options without some sort of some method to quote a mid price. But equally, you can't quote that mid price from actual traded data until it trades for the first time. Right?
Chicken and egg problem, right? Yeah,
yeah, chicken.
It's
exactly right.
Is that what it's called? Chicken and egg problem? I think. Yeah, but you touched on it perfectly, where you kind of run into this catch-22 of just you need to establish a market, you need to establish fair value, but until that market matures, you need training wheels, right? And something to sort of give it like a starting point, like the 0 to 1 process for that market. And it's going to be interesting to see, how we evolve ourselves as well. So one of the things that we're leaning on with that in particular is to support an ARB options market, right? And so we'll be using that for sure, in the initial stages to sort of bootstrap that market for us and sort of see how that evolution works for that market. I think the idea, as you mentioned, for most people would be too, is to eventually be able to trust your own market, right? And if you can trust your own market and the market itself is stable enough where the chances of wicks or improper pricing are sort of minimalized in terms of like the adverse effects, then you could start to just say, you know what, this is the market clearing IV, this is where it trades at, right? And so this is where people want to trade, this is what it's worth, right? And I think also too, at some point it can be a little tricky when you're dealing with products. Each product sort of has its own econometrics, I guess that's the word, but like the sort of distribution of tokens, how they're allocated, major events, sort of the idiosyncratic kind of issues that would kind of arise from a very just specific to the token itself will have to start being reflected in the implied volatility. And so it's kind of curious to also see how insider trading kind of evolves with this, because I think when you have the smaller the token, the more influence larger players in that market have, and ability to kind of move that market. And so the ratio of like informed to uninformed trading kind of skews against market makers and prevents them to even want to make markets in that, because then the only people that they're trading with end up being the people who are essentially informed, not traders, and know of some sort of event happening right before it does. So we'll see kind of how that evolves, but I think it's been a common problem for the whole space for probably a few years now, and it's kind of nice to see that like we're sort of moving across that risk spectrum, right, and away from BTC and ETH, and we continue to try to explore, along that frontier, that risk frontier, to kind of get into other markets. So it'll be nice to see that when we launch that.
Totally agree. And you touched on a little bit, the problem with why that hasn't happened before. If you're a market maker and some token founder comes to you and says, look, I want to buy like a bunch of out of the money puts, you get a little bit worried, right? Like, what do you know that I don't? Why do you want to buy all these puts? You're the guy holding all like 90% of the supply of the token. Like, I'm going to charge you some spread like this. But yeah, what I'm quite excited about is that we now have a framework to add altcoins almost systematically here, I guess, right? It works for Arbitrum, and we can bootstrap a market from some correlation. Then adding new tokens should be a matter of finding new correlations to previous altcoins. And once you get a market that grows like that, you get more confident in making those assumptions that this looks like this should trade in this way with some idiosyncratic factor on top of it. Yeah, I'm very excited to see it move past Bitcoin and Ethereum. I think I've been looking at the Bitcoin vol charts for the last 4 years of my life. I think I could draw it.
I think everyone is, right? Yeah. It's tough though. I mean, you have, in order to, the tough part with options is, in order to have a healthy option market, you have to have a very liquid and healthy underlying market. And that isn't always the case, right? And so the amount of tokens, I think it's obviously more than BTC and ETH at this point, but I don't know like how large that list is of products that would probably, check like a lot of boxes in terms of being a healthy underlying market.
Yeah, like what will actually have volume? Like you have 3 XRP ETFs looking to get approved, but like how will those trade when you already see that like the Ethereum ETF is peanuts compared to the Bitcoin ETFs?
Yeah. And so like, I think what ends up happening is when you look at sort of volumes and sort of market interest, right, you have an exponential decay of market liquidity, depth, trading volume. And so we're extremely top heavy, right? Like to the top 3, 4, 5 products. And then after that, like you said, you're talking maybe like 5-10% of the liquidity, right? Is the difference between, say, like a number 1 ranked coin and a number 7 ranked coin. Like 7 ranked coin you would think is pretty close to 1, but it's out of thousands of coins. But reality is it's a lot closer to the 3,000 ranked coin than it is to the number 1 ranked coin.
Yeah, there could be literal billions of dollars in market cap difference between 7 and whatever placement you're talking about.
Yeah. We'll see. The ETFs, you guys keep bringing that up, and I think that's interesting, is because you do keep seeing headlines come across, even more so, not just XRP. I think I saw some Doge ones hit headlines recently the other day as well. I'm not sure how they're going to trade, but the more markets,
it just shows interest outside of our bubble.
right?
We operate within
We need that.
an echo chamber for most of what we do, because the criticism we get, the feedback we receive, the people we reach out to for assistance or to look over things, they all eat, sleep, breathe crypto or some form of options, derivatives, like what may it be. They are full-time in this. And when you start hearing about the ETFs, that's from a different bubble that exists. that's trading the same instruments that has no interest in trading on chain or trading on Binance, OKX, anything like that. So anytime that I hear about, some new financial product that people are going to start using on the outside, it, piques my interest a bit, even though I have zero interest in XRP ETFs whatsoever, a Doge ETF, any shit like that. I think they'll all trade like shit, but I do think that it shows that people are willing to trade stuff like that. There's interest in at least basketing things like those, which may be the reason that a lot of them are being created, so that they can just create these index baskets and allow people to have the top 10 or top 5. And this is just, the first step into that. But
I think those index baskets or basket indices, those will be the next big step, I think, for crypto in ETF world. The real interesting thing happens then when you can like trade options on like the crypto index, like options on the S&P, for example, just the analog to crypto. Then you get some incredibly interesting stuff from trading perspective, from even just a research perspective, right? It's then that you start to get these implied correlations between assets within that basket, depending on how their individual options markets trade versus how their index option market trade, right? This is a very, maybe not popular, I guess, but a common trade in S&P options world, I guess. Having that index then opens the crypto world up to a massive world of interesting ideas, at least for me, in what I do day to day. And I'm surprised we haven't seen much of that on chain, right?
We have in the past, and they've done really poorly. Like DeFi Pulse had a top 50 index, and they also had a top 10 index. There was Bankless had an index. There was another protocol where you could create your own index. And the problem is like the same issue with what Tolga brought up. You have the top assets, and then you have the rest of them. Everything performs really well in their own micro cycles. But overall, you usually have this giant drag or drawdown from the bottom. Well, not even bottom, but just from the 99%. And if you are indexing and you're not, able to leg out of your index and just into a single asset, or just completely get out when the market's turned, then you are, locked for 3 months of pain while you're stuck in this, basket of assets.
Why 3 months? I'm
just throwing a totally irrelevant number. Like some of them were lock into a vault that trades for this with this asset, or this index of assets.
They'd have time locks on those indices, those vaults.
What's that?
Were you saying they have like time locks on them, or were you?
Yeah, I'm saying there were protocols that had like you could create your own, vault indice, and people were trading those. But then there were just ones like the DeFi Pulse Top 10 and the Bankless where there's no lock involved. That was just they built an index, there was a token created for it, and you could trade it. And with that is what I'm saying. There was kind of the problem that you were alluding to with even just like liquidity. It's the same thing with profitability. It's that your majors, are going to kind of hold everything together for the majority of that cycle, and your miners are only going to have their micro cycle of outperformance before they become like the drag on that index
or underperformance, right? When people are getting out of that index, and then all of a sudden there's all of this sell pressure, right? Because the index just has to get rid of the assets it's holding. The liquid markets will hold up fine. The illiquid ones will get murdered, right?
Yep.
So you have that sort of issue. Andrew, I have a question, because we were just kind of touching on like going off of what Cozy was saying about like we're in our own bubble. Do you guys see any interest coming from outside the bubble, right? Like, do you see any more like traditional finance firms, maybe people who are dipping their toes into crypto? They're still more a little bit traditional finance, but there's sort of that evolution, right? Like where they're kind of getting, I think BTC and ETH are a little bit more acceptable now in TradFi, right? It's a little bit more mainstream for them now and not as exotic of a product. Do you kind of see them sort of pinging you guys, asking you questions, kind of trying to figure out what you guys are doing and how everything works at Block Scholes?
100%, more than 100%, 200%.
Fink gave the green light.
Yeah, the difference from like pre-ETF and then pre-Trump, frankly, in November to now is quite strong. It's quite stark. I think we position ourselves as quite an institutional-looking brand. We're doing things the right way. We are, as you said, full of TradFi boomers with experience. A lot of these institutions with connections. A lot of these institutions as well. So we are trying to position ourselves as first in line to serve these guys as they look to make forays into this space. So seeing a lot of interest from banks, not just in the US but European, Asian. I think everyone is trying not to miss that boat. Looking
That's great to
for,
hear.
yeah, definitely for us, right? I think looking for two things essentially. One is data. I think finding a good source of data is tough in crypto. But it's such a necessary thing for understanding this new space. And secondly, just information. Still find there's a big education job to do. You have more and more, what I'm noticing is like true believers of crypto within teams who are some sort of
pushing the narrative, like pushing adoption. Yeah,
exactly, pushing adoption, looking to make that a thing within their desk or within the bank or within the fund that they run. But for a lot of the other guys, it's still about education, understanding what the space is. So what we're trying to do in research is try and serve that need. I'm going back to basics, like what is a stable coin? How does Uniswap work? How does Bitcoin mining work?
I imagine inverse options are probably also a little odd to people at first too when they see that.
Yeah.
Like, wait, what?
Like modeling that was tough for us, right? Because this is something we need to take into account if we're combining Deribit with Bybit, with OKX, with you guys, which with whatever, right? That was actually something a problem we need to solve the very early stages of building our volatility surfaces or our calibration tools, as well as some other stuff, right? Like the embedded interest rate on Bitcoin, right? We're treating this thing as an FX, as a currency, right? We're applying FX models like SVI. It comes from FX trading. For that, you need a domestic rate. Okay, we know it's somewhere near 5%. We can grab that from wherever. But what is the risk-free interest rate that you get on Bitcoin? That's not obvious at all.
That's a fun conversation.
Yeah.
It's like that's a whole like spaces in itself. Right.
Exactly. Yeah. But back to the point of institutional adoption. This is the sort of quality that the quant desks on these teams will expect, right? So we're trying to be that bridge between what the professionals expect in terms of quality of data and research and of service, as well as coming to that conversation with great crypto knowledge, having done the sort of nitty-gritty stuff that makes this space a bit weird, which is why we love it, right? It's some weird stuff.
Yep.
But in terms of like institutional interest, it's never been more exciting. I think there is that green light now in a place, in a jurisdiction like the US. I think that unlocks it for everywhere else in the world as well. They're sort of forced to follow. So quite exciting.
Yeah, that's what we're hoping for too. A lot of for Kyan, which essentially is the evolution of Premia's new exchange. The idea is to be a little bit more towards that institutional based user type or the pro-tail user type. And so I think that user type has been missing in the DeFi space for quite a bit. I think maybe like the Susquehannas of the world have always been around, sort of more on the SEX side of things, but trying to get the institutional side to migrate to DeFi has always been a challenge of ours, right? And it's not just ours; it's been everyone's, right, for the most part. So it's going to be interesting to see how we can sort of continue to sort of bridge that gap between decentralized protocols like ours, you know, the entry point or the gateway drug to crypto, which is or crypto derivatives, which is Deribit, to then the traditional finance, right? And sort of that bridge between all of those, and essentially make it a little bit more seamless, right? In terms of its flow, its process, standardization. I think there's still a lot of nuances, like you mentioned, with crypto alone, that there's an educational like overhead, right? And jumping into crypto is not it's not an easy transition. It's not a one-to-one transition, right? And so for a lot of institutions, unlike, you know, we even talked about this before in spaces where in DeFi, there's a lot of people who will take large risks, right? They're very comfortable doing things without verifying contracts or verifying what it is that they're actually doing. It's just, let's see if this works, right? Whereas institutions will do the exact opposite. They need to tire kick something for 6 months, have a meeting for a meeting, and then have another meeting just to be sure. And then finally they'll dip their toes in. But when they come, they typically stay, right? Like that's been sort of the thing we see is like with retail, they kind of come and go in herds. They're in one day, everyone's like talking and Twitter's lively, right? And then all of a sudden, like everyone just kind of disappears, right? Back to their day jobs, and they sort of like gambled away their money. Institutions, right? They do it as their day job, right? So it's an everyday thing. And so the hope is that if you're seeing that, hopefully eventually we'll see that as well. And then that fosters a much deeper liquidity, right, in the marketplace. And then you get that ability to do the indexes, which we just talked about. Recalibrating the vol surfaces, it becomes a lot better, right? And so there's that evolution. I think they've always been that missing piece that I think that just hasn't sort of come in. And then that regulatory, you know, shift in the US has been huge. It's been a massive weight lifted off of everyone's shoulders, right? I remember, I mean, what was it like? Kind of like September, October-ish, right before elections. Like I think everyone was at a like very low like outlook, right? Just uncertainty was extremely high. Everyone's been pessimistic for just beaten down by sort of Gensler's sort of approach of things with SEC, and everyone's just been afraid to do anything. And it's just nice to kind of see that like all these institutions have sort of kind of opened up and like, okay, let's move, like we can start doing things now, right? And so hopefully we'll see a lot more of that. I'm pretty excited.
The other thing is, you know, it is just a different in user type altogether, right? Like you have one that has maybe a mandate for a multi-year strategy to be running to make profit, whereas the other one is trading their biweekly wages, hoping they can, you know, gamble an extra week's worth of wages on, I don't know, whatever body part coin is the flavor of the week. You know, it's not the same type of interaction or research being done, or, you know, like overlook on the market. You know, it's the difference between people that are looking at daily charts and the 1 minute chart.
Yeah, it's also a very different type of flow, right? These guys trade at different times for different reasons, which is always healthier for the market. You never want liquidity to dry up in a crash, right? And crypto somehow seems to do the opposite of that. It's like liquidity is always highest during volatility. But you'll have people trading spot futures, derivatives, perps, options for different reasons to you know, pro-tail or retail, which is always a buyer when you need one. I think that's going to change the market quite a lot, actually. And I think we're ready for it. It'll be quite exciting.
We are as well. We've been waiting for a long time. You know, it's something you were talking about a bit earlier, like
5 years. Yeah.
yeah, just on the interest, you know, of these options. Like, yeah, me and DK, it's been 5 years now. Like, people wanted this stuff back then, there was a lot of interest in altcoin options. It's just that there are all these other factors that go into it. And one of them being, needing people like Block Scholes for pricing, because most people don't know how to price options and they don't have a baseline to work with at all. So they're just going, oh, I'd like to be paid this much money for this option, for this asset, and give me 6 months. That's the thought process they're taking themselves through, and they don't really know what they're doing. So there needs to be some kind of hand holding and accurate pricing and tools there to assist them in the process.
And to piggyback on that, I think that's what makes this like a good partnership, right? Like I wouldn't say it was a band-aid per se, because our models were grounded in a lot of truth, and I do appreciate all the work that we did in the past, but it's not the core business model that we want to be in the future. And I think from a separation of concerns, it just makes sense, right? To not be pricing the options in which that you're using throughout the exchange. So it's really nice to see, continued interest in the space, different organizations coming into the space. The services that you provide was like super nice for us. So we didn't have to think about that and all of the concerns and different parts of the team that have to be knowledgeable about that. I'm super happy about utilizing Block Scholes in our exchange in the future. And there's a lot of really cool stuff that you guys are working on, and we're going to continue to iterate and add more functionality as we get the exchange up and running. And good to go with one altcoin pair, and then we'll continue to advance on that.
Yeah, it's been a breath of fresh air seeing you guys, Andrew, be interested in kind of taking a we'll say methodical approach to exploring altcoin options and creating these services, because I really don't know many other teams that have tried doing that outside of us early on. And as DK said, that's not something that you really want to be in the business in if you're the one that's running the exchange. So it's with great pleasure that we're partnering with you guys, and I'm really looking forward to the next product release with Kyan. Let's see what we got in the chats here. Grand. Yep, Grand, we got Block on. You know it. He said we trade options to become grillionaires. I feel like that's a hat too. It's got to be.
Stack 6 on top of your existing 5.
Yeah, Grand is one of those guys. He's one of those desk guys. We got to get I'll get you a link, Grand, so you can take my little type form and get early access to Kyan feedback.
Cool. I mean, from our side, we're super excited. Me personally, I just want to see more cool things trade. I want to see more options markets. I want to see more altcoins trade. It's just even more cool and a pleasure to be a part of, building that and bootstrapping a market around it.
Yep. Oh, Grant said cool. All right, let's see. I don't have any other questions in the chat. So Andrew, it's been a pleasure. Thank you very much for joining us. You'll have to come on again, either to another premium stream or join us on Eden one of these mornings. I don't know what time that is for you. It's probably pretty late here. So
Yeah.
Yes, I'm GMT. I'm UTC +2, +1.
We'll figure something out. Yeah, no problem, Gran. We'll get you in. Yeah. Thanks again, Andrew. Everyone, thanks for tuning in. Always a pleasure. We'll be back again on Monday. Is it Monday that we're doing the call, Tolga, DK? I think it's on portfolio margin.
I have no clue. You guys just tell me to
not that I know
show up.
Maybe it's Wednesday. We'll see you guys back for Eden Monday, Wednesday, Friday, this Friday in the morning. And then next week, we have another stream coming up to go over, I believe, portfolio margin in more detail. You'll hear from me on Friday with the exact date on that. Thanks for tuning in, everyone.
Awesome.